Welcome to SR Money News. Today we dissect the fundamental shifts in India's financial ecosystem, specifically evaluating the prospective ending of zero-cost digital transactions and rising transaction taxes on retail trading. Over the past decade, the Zero Merchant Discount Rate, or MDR, policy on UPI and low brokerage models served as the digital highway for Indian retail capital. Think of this zero-fee structure as a toll-free highway. When the road is completely free, millions of vehicles rush on, creating unprecedented traffic and economic activity. In financial markets, this architecture catalyzed a massive surge in retail demat accounts and daily transaction volumes. However, as the underlying infrastructure matures, maintaining a zero-fee ecosystem becomes financially unsustainable for payment processors and financial intermediaries, like Angel One, and payment facilitators like Paytm. The core value proposition of frictionless capital entry is now transitioning toward monetization. Understanding this structural shift is vital for institutional investors assessing the future margin profiles of exchange platforms like BSE Limited and major banking institutions like HDFC Bank. Examining transactional metrics across the capital markets reveals how regulatory adjustments directly filter down to corporate income statements. Recent regulatory discussions around reintroducing a modified merchant discount rate on high-value UPI transactions, combined with enhanced securities transaction tax hikes, represent a pivotal shift in ecosystem revenues. MDR is simply the fee that a merchant pays to payment processors for handling a transaction. Imagine buying a cup of coffee with a debit card. Behind the scenes, a tiny fraction of that payment pays the digital piping. When that fee is zero, processors must subsidize the system. Reintroducing even a fractional percentage fee restores baseline net interest margin expansion for merchant acquiring entities. Simultaneously, increased transaction taxes on futures and options segments alter the cost structure for high-frequency trading. Early market data suggests that while top-line transaction volumes may experience short-term friction, fee-earning institutions will see an expansion in operational yield per transaction. This fundamental pivot moves the industry from pure volume-led growth to high-margin structural monetization across banking networks. Direct policy signals from regulatory bodies, including the Reserve Bank of India and the Ministry of Finance, indicate a strong push toward fiscal self-sustainability for financial infrastructure. For years, government subsidies offset the cost of zero MDR, but budgetary reallocations are signaling a gradual taper. Regulatory guidance emphasizes that long-term system stability requires self-funding mechanism models. When payment processors and discount brokers are forced to internalize infrastructure overhead, capital allocation strategies must evolve. Prominent players, including Angel One, are adjusting their operational guidance to prioritize customer retention quality over raw user acquisition. Think of this strategic shift like an airline changing its focus from filling every seat with discounted tickets to filling premium seats that generate actual profit. Furthermore, systemically important financial institutions like HDFC Bank are posturing to capture higher market share in institutional transaction processing, where pricing power remains intact. Policy guidance clearly signals that the era of artificial fee suppression is concluding, clearing the runway for realistic yield discovery across payment rails. Looking at the macro environment, Indian financial markets are entering a mature phase characterized by capital rotation and institutional reassessment. Capital rotation refers to institutional investors moving money out of high-volume, low-margin speculative retail channels and directing it into high-conviction, fundamental balance sheets. Picture water draining out of a wide, shallow pool and concentrated into a deep reservoir. The total liquid mass shifts toward stability rather than superficial spread. The broader macroeconomic backdrop reveals that rising global interest rates and tighter local liquidity mandates necessitate higher returns on invested capital. As retail trading faces incremental tax frictions, the rapid velocity of retail capital moderates. This shift benefits established stock exchanges like BSE Limited, which possess strong pricing power and diversified derivative offerings. At the same time, FinTech operators like Paytm must pivot from pure user aggregation to monetization through credit distribution and wealth management products. Macro dynamics confirm that liquidity is becoming selective, rewarding platforms with pricing power. A rigorous risk assessment highlights key systemic vulnerabilities associated with rising transaction costs and potential UPI MDR reimposition. The primary vulnerability is volume compression. Volume compression occurs when higher trading taxes or payment fees reduce the frequency of trading. Much like adding heavy lead weights to an athlete's running shoes, it slows down rapid sprinting. If retail option traders face higher friction costs, total contract turnover declines, impacting brokerage revenues across platforms like Angel One. Additionally, payment processing platforms risk merchant pushback if MDR rates are introduced without immediate added value. Regulatory risk remains elevated, as sudden adjustments in tax rates or clearing charges can temporarily disrupt business models before corporate balance sheets adapt. Furthermore, traditional banking heavyweights like HDFC Bank must balance infrastructure expenditure with digital security investments amidst rising compliance standards. Investors must carefully evaluate these regulatory cost inflation headwinds, as short-term volume contractions could temporarily pressure price-to-earnings multiples across the financial technology sector before stabilizing. Reevaluating forward valuation multiples requires a balanced view of short-term volume friction against long-term margin resilience. While initial news of potential transaction taxes creates headline volatility, structural monetization ultimately enhances forward earnings visibility. For financial infrastructure providers such as BSE Limited, fee-based revenue streams offer exceptional earnings predictability, insulating the balance sheet against broad market downturns. This concept of asset insulation acts like installing a high-grade thermal shield on a spacecraft. No matter how hot or cold the external environment gets, the core instruments inside stay protected. As low-margin speculative trading stabilizes, higher quality, long-term investment capital takes center stage. Valuation models for payment processing entities like Paytm are similarly transitioning from price-to-sales ratios toward sustainable EV to EBITDA metrics. As free transaction models yield to sustainable unit economics, financial intermediaries capable of defending their net margins will experience multi-year valuation re-ratings, positioning disciplined operators for sustainable multi-year compounding. The multi-year outlook for Indian financial infrastructure remains exceptionally robust, grounded in the transition from subsidization to economic reality. Over a 3 to 5 year horizon, the integration of fractional MDR and calibrated trading taxes will establish a mature, highly resilient transaction ecosystem. Rather than damaging retail participation, this structural evolution eliminates speculative churn, encouraging disciplined capital formation. Discount brokerages like Angel One that diversify into wealth management and lending will compound asset management fees alongside transactional income. Concurrently, dominant infrastructure anchors like BSE Limited and Tier 1 institutions like HDFC Bank will consolidate market share, leveraging their massive capital cushions to absorb regulatory changes effortlessly. The forward narrative is not one of industry contraction, but of structural upgrading. Investors who look past short-term tax anxiety will recognize that a self-sustaining, fee-earning financial grid creates a far safer, highly profitable landscape for long-term equity growth. In summary, the potential end of zero MDR and the recalibration of market transaction taxes mark the arrival of market maturity for India's financial sector. The shift from volume-chasing models to sustainable unit economics provides institutional investors with unprecedented clarity regarding long-term cash flow generation. By understanding the balance between volume compression and margin expansion, portfolio managers can strategically position capital in resilient assets like BSE Limited, HDFC Bank, Angel One, and Paytm. Thank you for analyzing these macro shifts with us on SR Money News. For continuous institutional-grade market intelligence, institutional research, and deep economic breakdowns, ensure you like this video, click the subscribe button, and turn on all notifications. Stay ahead of regulatory shifts, protect your portfolio capital, and join our growing community of informed investors. We will see you in the next analysis.